Well, hello and a very warm welcome to this webinar. Inflation, how bad is it for European banks? Brought to you by Scope Ratings. My name is Keith Mullin and it's my pleasure to be your moderator for today's session. Now, of course, as we've all seen, the upward shift in the inflation and rate scenario has coincided with significant corrections in equity valuations and credit spreads amid, at times, significant volatility. Now, one of the questions that we're seeking to answer today is, does this contradict the view that rising rates are good for interest margins and bank profitability? Does it suggest we could be in for some asset quality deterioration? Well, to answer these questions and to give their views on the current scenario and the near-term outlook for European banks, I'm delighted to introduce our fabulous panel for today. So we have Marco Troiano, who's head of bank ratings at Scope Ratings.
Good afternoon.
We have Bruno Duarte, who's financial credit analyst at Algebris Investments, the London-based independent global asset management firm, which engages in long-only and alternative investment strategies. And then we have Romain Migignac, head of research at Atlanticomnium SA, the Geneva-based independent investment manager, which also manages bond funds for GAM Investment Management. So welcome to you all on the panel. Looking forward to a great conversation. So for this session, we're actually dispensing with formal presentations. We're going to move straight into an interactive panel discussion. At the end of the discussion, we'll be more than happy to take questions. So please do type your questions into the Q&A box on the platform. So that's it from me. We're going to get straight into it. So Marco, I'm going to start with you, if I may, just to kind of lay some groundwork and for our conversation. Of course, the topic of how inflation affects banks is not a simple one to answer. It's got lots of different facets and sub-themes around it. And we'll get to some of those as we go along. But just to kick us off, can you lay out some just general thoughts about how you see the European banking context today?
Yeah, sure. Well, first of all, I think we've come out from one of the worst crises since I'm in business, which was the COVID crisis, which didn't really show up anywhere in banks' performance, thanks to the massive support. And just as we thought we were out of it, then we got a war and big change in macro environment characterized by this high inflation. So I think this is going to be a very testing time for the sector and a very interesting period to watch, to gauge for the second time whether the new regulatory infrastructure and whether the new risk appetite of the sector is indeed as robust as we think it is post-great financial crisis. So this is, I think, for me, the starting point. I tend to be an optimist, but there are obviously things that we need to watch very carefully. When things change very fast, not everyone is able to adapt at the same pace. So I think it's going to be very interesting for the next probably couple of years to see how the sector adapts to this environment.
Okay, thanks. And Bruno, can you pick up on that? So I guess Marco's point is that what could have been, or what on paper could have been a pretty torrid time during the COVID crisis did not turn out to be so deleterious for the banks, even all the fiscal and monetary support. Is your position today, a fairly positive one? Are you sort of slightly concerned? Are you uncertain? Where's your mindset around European banks today?
Look, I think probably one of the less well-known secrets of the European banks landscape today is they're actually in a much stronger position post-COVID. To what we were saying earlier, the fact is that this was actually a much bigger slowdown. I don't think the world has ever been put on a standstill, a government-enforced standstill for 2 years. And that's effectively what happened. So the natural default reaction was always going to be, here we go again, global financial crisis, it's it all over again. The banks are in trouble, the banks are going to go bust. But I think the main difference this time around, and why we're optimistic on banks and why we think it's very different from 2008, is that in 2008, the banks had asset quality issues, they had liquidity issues, they had solvency issues. And in the 12 years or so since then, we actually have a much better capitalized banking system. We have liquidity measures in place from all the central banks. We have solvency ratios that in some cases have tripled from where they were. So the banks have gone from being a kind of like an albatross around the central banks and the government's necks to actually being conduits. So the banks and the governments and the regulators actually walked hand in hand from 2020 onwards, because the reality is no credit growth, no economic growth. Especially that is very, very much the case in Europe. The US is slightly different. Europe really relies on the banking sector being able to foment credit growth. And I think that's why we've emerged stronger from this, because there has been proof now that the banks are in a strong position. They are here to stick around, and they can actually go on and do their business, no questions asked.
Thanks. Romain, do you support that view? And let me ask you a follow-on question. If your view is, broadly speaking, over the cycle, benign, given what Bruno was saying, are current credit spreads Christmas come early for investors?
Yeah, no, I agree with all of that. I mean, very bullish on the European banking sector. I mean, in terms of fundamentals, I echo everything has been said. I mean, excess capital has gone to very high level, which is a big layer of protection for bondholders. I mean, asset quality, we're starting from a position of strength. I mean, NPLs have actually declined during the COVID period, somewhat counterintuitively. But I think also that it's the de-risking that we've seen in the conservativeness in banks' lending profiles that's going to be a big driver, of performance during, whether we see a future recession or whether we see a future period of weakness. I think that's really going to be an aspect that's gonna make the banking sector one of the more resilient sectors. And I think it's also important not to forget that although we talk about the financial crisis, and yes, there were big blowups, we tend to remember that rather than a large number of banks that were actually profitable during that time, and were able to absorb the impact. So there's no reason to think that that wouldn't be the case in a future crisis, and that they wouldn't be able to absorb that impact. Then in terms of valuations, I mean, spreads have widened a lot. I mean, throughout the capital structure, as you would expect, the more subordinated parts of the cap structure have, tier 2 AT1s have underperformed. If we look at where spreads are, I think on European banks, AT1s were a bit above 500 basis points of spreads. Which historically is levels that we've only seen whether it's during the COVID crisis or during that kind of time. So we do definitely think that we're at extremely attractive levels, especially given our view that banks are actually one of the more resilient sectors. So we think that we're paid too much, and that we've actually seen too much decompression and too much underperformance, despite the fact that it's an environment where probably banks are one of the sectors that would benefit the most. So, it is a very uncertain environment. It is an environment where we expect to continue to see volatility, but I think on a kind of 12 to 24-month horizon, it's difficult to be wrong investing at this kind of level of spreads.
Yeah, thanks. I'll get back to you in a second, Marco. But Bruno, are you again? Is that would be your investment thesis at the moment, that because the spreads have perhaps widened too much before they snap back to more reasonable levels? Do you think now's the time to buy, even amid all of this uncertainty?
Look, I think a lot of it depends on what your investment horizon is and what your product or the policy that you have towards your investor is. I think it's very difficult to ignore and contradict what Romain just said, which is, outright levels across the entire capital structure are extremely compelling. I think we have to understand why we are there. And I think the reason why we're there, and I'm sure we're probably going to discuss it later, is, for the first time going back to 2018, the world's risk-free asset, the US 10-year, has become unanchored. Just before, we kicked off this webinar, one of the Fed speakers said that 3.5% to 4% is actually a normal rate for the Fed's fund to go to. And if you look at where we are today and where he wants to take it to, and if you think of, well, where will the 10-year be? You know, if the 10-year goes another 75, 100 basis points from here, then you know what? Our capital space and our funding space is actually going to look even more attractive by the time we get there. So I think a lot of it is down to, you know, kind of give me the ingredients and then I can make up a nice meal for you. Where we are today, ceteris paribus, I think it's very difficult to ignore. These are very, very interesting, very attractive times for a 5-year horizon of buying paper, locking it up, and going forward. If you, however, are being faced with uncertainty from investors, tactical asset allocations, then you do need to be nimble, you do need to stay more liquid, and that will basically predetermine what sort of investments you want to be chasing.
Yeah. Indeed. Looks like Bruno's frozen for a second there, but Marco, let me come back to you. So I guess a lot of this so far in the short time we've had, it's been a pretty positive views expressed. But there are some downside risks around asset quality, for example. You know, this is something that we talk about a lot, and asset quality has improved. I mean, materially since the global financial crisis. But there's always we always see this potential risk of a higher default risk as rates go up. You know, zombie company syndrome. I mean, if you had a crystal ball, how do you see asset quality evolving at the sector level in Europe?
Well, I think we're going to see a reversal in asset quality trends. If not this year, with some lag, perhaps starting next year. But again, it's not going to be this disaster and wave of NPL. I mean, for the past couple of years, I've been repeating the same message. There is no wave of NPLs around the corner, and that was the case in 2020, 2021, and it's still the case now, in my opinion. I think we were sometimes we tend to fight the last battle and tend to be fixated with NPLs. But the reality is that the sector has changed a lot in the way they originate, in the way they look at cash flow, rather than just collateral in some peripheral countries, in the way that the supervisors guides the banks in how to originate and manage their NPLs, in the way they tend to deal with their NPLs on balance sheet. And then this is a very difficult type of crisis. The mountain of NPLs that we saw accumulating, especially in peripherals in the global financial crisis, was in a deflationary environment. An inflationary environment is, to me, it should be totally different. See, collateral values go up; they're easier to refinance. It's easier, to basically sell a property and pay off a loan rather than end up in a years-long repossession process. So I don't see it. I think some tick up in defaults is unavoidable as the economy slows, and it's also unavoidable as we go into an inflationary environment, and that's because companies are not used to work in inflationary environments. I think I've never seen an inflationary environment in my life. I think that's the same for most of the people currently in business as well as in finance. So that's something very new, and you have to steer a company in very different ways when you're dealing with inflation rather than disinflation. So I think there's going to be some frictions there, but nothing that the banks can't manage, nothing that the banks can't absorb out of their pre-provision profits, and nothing that can become a financial stability concern, in my view. I mean, if anything, I would be worried what happens outside of the banking system.
Right. Reason. Okay. Well, I'm old enough to remember recessionary environment very well back in the day, but that's another story. In terms of, I think as Romain, you mentioned, or perhaps I think it's Bruno, that the bank's capital levels are pretty robust, Romain, and I think that it's interesting how kind of the debates evolved around, investors focusing on distance to buffers and all the rest of it, and difference to minimum capital requirements. Is there a case for potential argument that banks are overcapitalized, given that they've got so much headroom? And is that inefficient from a business perspective?
Yeah, so look, I think from our perspective, we always look at capital and levels of of excess capital. This is to MDA, which is what protects us. Whether we're buying AT1s or more generically, but the reality is the first line of defense as a bondholder is earnings, right? That's the first line of defense. That's what banks have every year available to absorb losses, or do whatever they want, like distributing to shareholders, funding growth, etc. So I think as bondholders, there's the part around capital, but the pre-provision profit part, that's the part that we should focus on, and that where we should have a view on okay, how does stress losses look like in a very bad scenario, and how does that compare to your pre-provision profits, and actually whether earnings, whether pre-provision profits go for loan losses or whether they go for share buybacks or for dividends, it has zero impact on us as bondholders. So if you could argue that that's the first line, that's the first line of defense, and that's what should be seen as one of the most important areas. Yes, it's nice to see banks having big ROEs, etc. But I would argue that in an absolutely worst case scenario, an ROE of 0% and no dividend share buybacks being paid, that's a great outcome from a bondholder's perspective. It just shows that banks have the ability to manage that without impacting excess capital. So then there's the question of, do banks have too much capital or not? I'm a credit analyst, pure, focused only on fixed income instruments. So especially lower down the capital structure. So I don't think I would ever complain about seeing too much capital in the system, but it needs to be acknowledged that for banks to be to be profitable, to be attractive to equity holders, which allows them also to raise equity capital, it needs to be commensurate with the actual level of risk that we have in the system. So I think the place where we are now, I think we can argue that banks are very well capitalized, and I don't think we need to have more capital from here, especially as my personal view is, even in a very worst case crisis scenario, I don't even think you would need that excess capital. I think earnings as a first line of defense would be enough to cover that. Just to give you, I was doing some before the panel, some kind of back of the envelope calculations. You look at BNP, which is kind of 15 billion in pre-provision profits. I think during COVID they took 5 billion of loan loss provisions. So for them to start making a loss, you need to see 3 times that. And I think if you compare to the cost of risk that they had at the peak in 2009, I think you need twice that for them to be loss making. So I think yes, banks are well capitalized, but I think as a bondholder, there is another aspect that might be even more important to consider.
Yeah. And so Bruno, I'd like to get your view on this as well, because thinking going back over a number of years now, the conversation goes along the lines of we're comfortable with banks' capital positions, liquidity, funding, but profitability has always been an issue, right? So the return on equity, whatever cost of equity you input, they're substandard, certainly against US banks. And so do you have any concerns about the lack of profitability and the ability of European banks, if they can't push their profitability through earnings, and it's obviously the cost cutting has been the name of the game as well. Do you have any concerns about that?
Look, I think lack of profitability and trading sub-tangible book for European banks has been the case for decades now. I don't think it's any new phenomenon. I don't think anything has changed. And whether you believe it's because interest rates were zero, they were negative, the jury is out. The reality is that, US banks have a very different balance sheet structure from the European banks. So that's from point one. The US banks don't really originate or keep a lot of mortgages on the balance sheet. You come to Europe, what's the one hook product that all the banks do in Europe? It's mortgage banking. So right away, if all you're doing is credit card lending and corporate lending and CRE lending against the bank that is doing 50, 60 basis points mortgages, it's natural that the profitability of the second is going to be a lot smaller than profitability of the first. It's just the way the cookie crumbles. There's nothing you can do about that. I think where Europe has been very successful is consolidation. You look at Spain 10 years ago, you look at Spain today. You look at other places like, for example, in Italy as well. So I think a lot of the weaker names have consolidated, they have gone forward, and I think that is positive for profitability. But there is, I think, a natural glass ceiling in Europe that, again, just because of structural features of the banking system in Europe, it means profitability online with what you see in the US is going to be difficult to achieve. But, I think they've come a long way. On the point of are banks overcapitalized or not, what I would say is that there needs to probably be a bit more harmonization of capital levels and definitions across Europe, because I think what you find is that one bank is happy to run with a deficit of AT1, and it basically does not want to fill the Pillar 2 with the excess of AT1 that it's entitled to, and there are others that want to run it full. So at some point, you're going to have to double count. And I think what's also interesting is if you look at the levels at which AT1s have now been issued, and we've had like a couple of them coming with very high coupons, is that now at a level that it becomes inefficient for banks, which means they should be filling with equity. And if they're filling with equity, they're actually having to retain more capital. So I think there's a lot of existentialist questions that will now be asked of banks' managements and funding and capitalization schemes. But overall, to what we've said on this panel, I think the measures in place, the underwriting standards, how business is done today versus how it was done in the past, I think, again, this sector today is night and day to what it was in 2008.
Indeed, thanks. And Marco, one of the things that has come back, again, it's got rebounds every so often, and it's one of these downside risk factors, and it particularly pertains in the last week or two to Italy, which is the sovereign bank doom loop. And of course, the ECB came up with their emergency meeting, and they were going to sort of defragment the sovereign bond market. Not entirely sure specifically how, but do you have any concerns, not just in Italy, but generally, but I guess Italy and immediate peripherals? Is that a concern for you as a credit analyst when you see
Of course.
you see the bond yields shooting up, government bond yields shooting up?
Of course. Before I go there, just a very quick comment on excess capital, which I have sort of been thinking lately that, and my view, I mean, I've been pointing to the fact that banks have excess capital from a credit angle for a long time, but I used to wear a equity hat a long time ago, so I'm very sympathetic with the need to have a viable equity story. But I think one of the impacts of sustained inflation, and I actually think that this is not something that we'll get rid of very quickly, is that banks will have to finance higher nominal risk-weighted asset growth. So I do think that there is room for cutting down a little bit on these excess distributions that we've seen over the past 6 months or 9 months, simply because you're going to have opportunities out there just from the nominal growth in your volumes. And potentially, Bruno was mentioning consolidation. There's going to be opportunities out there because when volatility shoots up, someone gets it wrong, and we know that there is still a lot of room for consolidations, including in places like Italy that have been mentioned, and that they are going through a process, of course. But this is one of the structural problems of banking in Europe. It's too many banks, too many bankers, and too many branches. To your question, sovereign doom loop, I would say yes. This is something somewhat that concerns me from time to time. There are several things that have changed dramatically, I would say. First thing is the banking union. So where you used to have a national supervisor, say Bank of Spain or Bank of Italy, where you could be concerned that banks could be essentially strong harmed into buying government bonds as buyers of last resort, you now have at least the large banks under the umbrella of ECB supervision. So I think that risk is actually a lot less, that the banks run up huge portfolios with the supervisor either not noticing or softly encouraging it. The second is the resolution authority and the resolution mechanism. So if a bank were to fail today, it wouldn't end up complicating the sovereign situation that much, at least under most scenarios. You would have bail-in and then resolution funds and so on. So I think the banking union has changed the dynamics of the sovereign doom loop. And I think perhaps for sure, even more important, we have a very different central bank. Back before 2011, you had a central bank which was only interested in central banking, and now you have a central bank which is also interested in financial stability, acknowledges it as a role of lender of last resort to the banks, it acknowledges it as the role of buyer of last resort to sovereign debt, so formally or informally. So I think that's a huge difference, but it's there. So you will have impacts every time you have widening in sovereign spreads. You would have impact on the funding costs of the banks. You would have mark-to-market impacts on the holdings of sovereign bonds, which are held in the trading portfolios. In very extreme scenarios of a sovereign default, you would have direct losses from the holding of sovereign bonds. And of course, if a government is cornered into austerity, you would have impacts through the real economy channel, which is in the end where banks operate. And if I have to say, this is also one element which really adds risk to European banks. Our politics in Europe are still too complex. Every decision that has to be taken has to go through too many approvals and too many decision makers with diverging national interests, and this makes things very complicated. And we've seen, the lack of progress on the banking union on the EDIS. It's clearly pointing in that direction. So I think it's still there. It's tamed, but potentially it's there.
Yeah. And Romain, do you have any concerns? Is a sovereign doom loop one of those things you read about but don't worry about?
Yeah, I mean, I think it's. I mean, first of all, like the kind of the strengths of some of the peripheral countries between the Eurozone crisis and now have changed quite significantly. I think if you look at Spain, is quite a good example. I think the worry from my perspective is more around market volatility, and kind of spreads reacting to that rather than any fundamental major concerns around that, unless we get into a scenario, as Marco was saying before, where it ripples through the real economy, and then you have NPLs increasing, etc., which doesn't really seem to be a base case, neither my base case. So it's really more about market volatility, and in current times where spreads have widened very materially, where markets are relatively dislocated, then the question is, do you feel like you're compensated well enough to be taking that kind of however you want to call it, tail risk or that? And I think that's the place where I would feel like some of the core European banks, or some of the more international banks rather than the domestic peripheral banks, when you can get these kind of names without sacrificing a lot of spread or yield, no matter how you look at it, the question is, are you really getting paid for the risk? And in some of the names, I don't necessarily think it's the case. So I think from my perspective, it's more from a market volatility rather than fundamentals.
Yeah. Bruno, what's your perspective on that, and particularly on this issue of where you position your investments in terms of if you're getting paid reasonably more, perhaps for reasonably sort of large European banks versus the perhaps second tier players. Does that sort of make sense that you focus on the big Europeans that are paying more?
Look, I think there's two elements to this, and there's your 35,000-foot view, and then there's obviously the view that you have coming up from the weeds. I think if we start from the top, I think it's pretty obvious that the sovereign doom loop, I think that loop has been broken. And the reason I say this is, if you listen to the ECB talks about favorable financing conditions. And if you try to understand what that's about, you just need to understand one simple thing. Unlike the US, in Europe, 80-90% of all corporate credit lending comes from banks.
Right.
If the banks cannot access capital markets to unload to their clients, then there is no economic growth. There will be unemployment because corporates have to fire people. Now, for the banks, they always lend as a pick to the sovereign. So the moment we start seeing the BTP Bund spread getting tested from 175 to 200 to 225, 250, that was the pressure point. And that came 3 days after the ECB press conference. So we know 250 is the pressure point at which it becomes untenable for banks to access funding cheap enough to downstream to their clients and corporates to foment credit growth, to foment economic growth. So if we believe in a common European project, and today Lagarde mentioned that Croatia is going to join as well, it's getting bigger, then we cannot be selling out a project of European Union enlargement, one big family, and leaving periphery by the wayside. So the notion of favorable financing mechanism means that they will have to hold sovereign spreads at a level such that the national champions in those countries are able to onload and on-lend to the clients that need it. Now, to the question of where do you feel more comfortable with? I think it's pretty obvious that, given a core bank investment in a BNP or an Intesa, or going into a BCP in Portugal, or picking up a second tier, third tier in the Nordic area, I think it's pretty obvious what you want to be in. But the reality is everything comes with a price. And I think here the key difference is as follows. We have a situation today in the world that is unheard of. We have 3 leading central banks all turning off 3 spigots at the same time. Rates are going up. Quantitative easing has gone to quantitative tightening. There's no fiscal stimulus that's coming out. This is happening simultaneously in the US, in the UK, and in Europe. Liquidity has been flooding the system. Liquidity is being taken out of the system. Investors like ourselves are the ones that are now providing the liquidity. We are stepping in for central banks. So you have to be mindful that when you're stepping in for the central banks, there has to be a spread level at which you think you're comfortable taking on that investment. And for the time being, until we get a sense of where the risk-free rate's going to go, it is quite difficult to make that decision. So I think it makes sense that for now, you kind of take refuge in the household national champion names with a little bit of exposure to the bigger second tier, third tier names. But once you get the all clear, once we know where we are, once we've seen peak inflation, peak rates, I think then that's when it's safe to go back into the smaller names.
Yeah, makes sense. So look, I mean, we talked a lot to date about sort of the sector from a sort of quite a high level. Wondering if there might be some upside and maybe perhaps focusing on some single names. And I think that I'm not asking anything perhaps that's not already public, obviously, but when I read things about Credit Suisse and its various episodes with the supervisors and various clients, or when I read about HSBC potentially going into a breakup scenario, UniCredit being hit by Russia-related losses, and it's in Italy, so it's that kind of high volatility zip code. There seems to be a lot of single name sort of headline news out there. I was wondering, as investors, to what extent you kind of have your heads turned by headline news, and that's more, I guess, more of a question about how you approach the market. I mean, are there any outliers on the downside within the large universe of European banks that you would perhaps be perhaps more mindful of investing in? Potentially unfair question, Romain. I threw out a few names there. I didn't mean to highlight any names in particular. They're just the ones that keep up recurring in the news.
Yeah, look, I'll be careful how I answer, but look, let me just put it this way. I think, in the kind of core European banking sector, I think the number of names that are problematic, or however you want to phrase it, has diminished greatly, to the point where now, I mean, beyond a few, and I think, like, Monty, or whatever, which are, I mean, not even, I wouldn't even put them in that universe. You don't really have any names that are really problematic. Then, in terms of headline risk, I think it's a question. It's always a question of, okay, there are some headlines for example, HSBC. How likely is that? You have to evaluate, first of all, how likely is that to happen. If that happens, what's the impact? What's priced in, what's not priced in, and then from there you can form kind of an investment thesis and go forward. And same with names like CS, where you have headline risk, where it's potential monetary fines, to still have quite a material impact over the next few years. The question is, if you compare that in the market to where some of the peers are trading, if you get XYZ pickup, do you feel like you're compensated for that uncertainty? And at what point do you think catalysts materialize for things to go, one way or the other? So I think it's really about, doing that kind of in-depth analysis to get a conviction one way or the other on names. But I think in all the names that you mentioned, I think it's more of a kind of, analyst and portfolio management view to see, okay, do you think those are the ones that might outperform or underperform in the next, few months or quarters, rather than those being names where there's actually a real concern fundamentally, like there was, with UniCredit, a few years ago, or with some of the other ones. I mean, the underlying businesses are all fundamentally sound. The impact, whether it's UniCredit in Russia, whether it's CS, can be absorbed with earnings, excess capital, etc. So I don't think these are real cases of, outliers, but rather, those where, there's still some issues to be solved.
Bruno, would you comment on that, on the same question?
Look, I think what I would say is this. I mean, the industry, the bank sector, and people sometimes always forget this. Stress test analyses are published every 2 years, but they're conducted every year. I think as far as the industry grows, it's the most over-regulated, over-scrutinized industry there is out there in the world. So, what I would say is, I mean, I wouldn't say it's impossible for these shocks to come through and surprise the market. But I think it's probably unlikely that we're going to see some bombastic headline come through that is so unexpected that it could actually take one of these players down and cause systemic risk. I always think back, about 30 years when the Fed started embarking aggressively on rate hikes, and everybody was trying to pinpoint where the first body was going to come from, and it came from Orange County. And no one at the time had even heard of what Orange County was. And that's the one that took, I think, almost like a $2 billion loss. I think they went bust, and no one even thought that would even be possible. So I think what happens in these type of scenarios, whenever you have an exogenous shock, whether it's liquidity being pulled, whether it's crypto down 65%, there will be a ripple, there will be an impact. Where that is, I don't know. I think it's very difficult to pinpoint, but I would not be surprised if it is outside the banking sector. Right. I don't think it's going to happen in our space because everyone is on top of this sector 24/7.
Yes, indeed. Marco, I just wanted to pick up on, I guess these are two subjects that are kind of symposiums in their own right, but we'll just cover them sort of quite summarily. The two big themes these are not risk themes, they're potentially challenges, but the two, I guess, overarching themes that are out there today for banks and corporates, but in the banking context, is ESG and digitalization. Now, quite often you'll see these people will pose existential questions around the banks that don't digitalize quickly enough because they're basically going to lose their shirts, either to competitors or to non-banks. ESG, subject to a swathe of, in the EU particularly, a swathe of incoming regulation, whether you're an issuer or an investor. Banks are now being subject to a taxonomy alignment ratios, et cetera, So to what extent would you think that either both ESG and digitalization are going to be game changers for the European banking sector over X period of time?
No, they are going to be game changers. The question is the period of time short enough for this to matter from a credit perspective? And we try to incorporate this in our ratings. In part of our analysis, we call long-term sustainability, but really it's going to be a very long process. So the question is, to what extent, the fact that a particular issue is either innovating or lagging on these two fronts is actually adding or detracting to their credit profile. And when I look at ESG, I think it's possible that you have governance being a driver of credit risk in the near to medium term. For environmental and social, it's much less likely. And although we're going to see a lot more disclosures in the next couple of years, and eventually the first few regulatory requirements around especially environmental and climate risk management, but I think it's still going to be a lot less likely than digital or governance being driving factors there. Digital is a real thing. I think if you're in banking and you get your digital strategy wrong, you could be out of business in 5 years. I think the sector is moving very fast, and there are some of the players, especially the big ones, are investing billions and billions. And in fact, I think one of the drivers of consolidations in Spain and Italy that was also mentioning is that these guys can't compete. Some of these smaller banks don't have the budgets to invest, and that's what the clients want. I mean, you don't want to be dealing with your bank when this is not up to the task when it comes to digital capabilities. And if you're a bank, you're going to have a competitive disadvantage in pricing risk correctly if you don't use your data right, and if you don't have the right degree of operating efficiency baked into your process, and that all comes with the cost of digital investments. So I think the digital is a real crucial strategic part of what banks are doing, and ESG is becoming definitely a strategic priority, and definitely very fashionable for banks to talk about it. But I think in terms of credit impact, it's going to be a more long and protracted issue.
Yeah, which is an interesting point, Romain. So yes, both. I mean, digitalization is going to be it's a long run process. ESG. Let's be honest. We're talking here about a pathway to 2050 net zero, which is a long time for a bank to think of it. It sort of goes beyond the kind of horizon of a lot of banks. But on a basis that they've got so much coverage at the moment amongst regulators and amongst bank management, are you seeing those long run factors being priced in today into bank spreads, or is it difficult to say?
So I mean, I think it's quite difficult to say. Based on what we're seeing, I would say, I mean, the governance aspect definitely priced in. I mean, you see those that are currently impacted by material controversies, trading at materially wider spreads than historically, or versus peers. So that's definitely something that we're seeing. Then the more long-term effects like digitalization or climate aspects, I don't think are materially or significantly priced in as of today. I think what I would say though is, yes, I agree. These are two long-term, phenomenons, and they're. It's likely that they wouldn't be, kind of material from a credit perspective in our typical time horizon. But I think they remain tail risks, and if it's maybe a bit over optimistic to think that, okay, fine, the transition to net zero is to 2050, so it leaves a lot of time. but change is not going to happen in 2049. Change is going to happen along the way. There's going to be disruption on that path, and there's going to be a lot of change. So I think assuming that it's going to be a smooth path to there without any disruptions along the way, that may come much sooner than expected. I mean, whether it's government, whether it's corporate, even banks are setting interim targets that are much closer. Regulators are taking a very keen interest into the kind of connection between climate risk and capital requirements and regulation in general. So if that accelerates and you start seeing capital requirements being more heavily impacted by climate risk, or kind of risk management capabilities on that side, if you start seeing banks being more penalized for not being advanced enough on their climate strategies, I mean, that might have an impact that's much more short term than we think. And digitalization is the same. It's quite heavily correlated, to cyber risk and all of that, which can have a big impact today. Then some aspects can be more challenging to kind of incorporate into credit analysis. But I definitely think it's something that's worth having quite a good look into. And those that are well behind on some of these aspects, why would you want to be exposed to these kind of tail risks?
Yeah, no, indeed. Bruno, what's your perspective on this? Do you, at this point, do you look at particularly ESG or any aspect of ESG? Do you look at that as an investment driver at this point, and same with digitalization?
No, we do. I mean, we actually have an ESG team here with an algebraist that we set up about a couple of years ago. So they're always very diligent. They're very on top of the thing. All our funds are ESG compliant as well, to certain degrees. Whenever we get management teams in, we're always scrutinizing and asking exactly those types of questions, because I think as investors, we have to lead that thought process. It's very easy to stick with the tried and tested, whether it's coal financing, oil financing, but we have to move on. This is a planet that's got finite resources. The population is growing. Simple mathematics tells you that there isn't enough resources to go around. So we have to basically make do with what we have. We have to be more diligent in how we approach, the distribution of them. And that's why we just try to do our best, and we try to lead the conversations where possible. We will basically put some issuers onto kind of like restricted lists if we're not satisfied with how they stack up on certain parameters that we have internally defined by ourselves. And we kind of go from there. On digitalization, I could not agree more. I think this is actually one of the growing costs, along with compliance and legal and MLRO, that will force the small banks to really struggle to compete. And it just is, again, it's just a big anchor in terms of profitability for them, which just forces the whole consolidation angle. You look at Spain, CaixaBank today is in a privileged position because it did Bankia when it did, and it can still have a lot of cost cutting dripping through to offset what will be inevitable, wage reset hires because of how inflation is higher globally. So again, these are all factors that I think are important to consider. The only thing I would say, though, on ESG, from an ESG investment point of view, and this is two things we've noticed, and I don't know whether it's just because it's the beginning, it's very embryonic, or it's going to change, is the notion that something is social or green doesn't really matter, because when you look at the market valuation-wise, green or brown tends to trade the same. And then the second thing I would say is green capital, as far as I'm concerned, is an oxymoron, because it requires you to be able to ring fence the capital. And we all know that, you're not going to be able to ring fence an AT1 or ring fence a tier 2 if a bank, unfortunately, God forbid, becomes gone concern. Yeah. So, I think there's almost an element of mis-selling ESG products, if it can be said that and put that way. And I think the regulators do have to probably step in, do something about it. I think it's very noble for an issuer to go out there and issue green capital. But I think conceptually, I struggle with how it would work in a resolution regime, because we all know that it can't really work in a resolution regime.
Yeah, absolutely. Yes, indeed, but we had a social tier 2 out this morning as well, to that point. But we need to close in the next few minutes. So I wanted to ask those of you still viewing, if you have any questions, to type them in now, if you could, because I want to move into our close at this point. So just type them into the questions box, and we'll do our best to answer them. I just wanted, there was one, I guess it's quite a specific issue around AT1s I wanted to ask Bruno and Romain, which is, if you go back over the history of the sort of most recent iteration of AT1s, this notion of banks not calling was treated with absolute horror and shock by the investment community, with cries of, oh, well, I'll never invest ever again in this bank, they didn't call their AT1. Since that time, we had a more nuanced approach to calling AT1s, name to name. And we have some that haven't called and haven't suffered really as much fallout as perhaps they did in the past. Some which have called but paid up to do so, and not to focus on CS, but CS with its $81 a week or two back paid up quite significantly to call a lower coupon outstanding AT1. So my question really is, how do you view the notion of call, not call? Is extension risk still as big a risk as it perhaps was back in the day? Have you kind of recalibrated your thinking around calls? Romain, why don't you have a stab at that one?
So look, I think nothing's really changed from our perspective. I think it's important to differentiate. Before Basel III, some of the older instruments that were issued and kind of structured to be called at the first call date with step ups, etc., versus new style AT1s that are issued to be perpetual, to keep their capital value if not called. And I think on that basis, the kind of working assumption when looking at valuations and when doing and when making investment decisions should be to look at it on the yield to worst basis and to be happy with that in case it doesn't get called. So to invest in those where the back end or reset or however you want to call it is at a level that you would feel comfortable with. That's the first thing. But I think the second thing is, unlike some other markets like the US pref, the US bank pref market, I still feel that it's not a market where all issuers are going to act 100% rationally. Although we can kind of argue on what rationally means. And what I mean there is you kind of alluded to CS and Barclays. They both called and reissued at a cost that was higher than the reset. So it shows that some banks are willing to pay up for whether it's reputation, whether it's to be debt holder friendly. And I think that's where, as is in everything else, the kind of doing your actual homework, speaking with issuers, getting a sense of how they approach calls has quite a lot of value add, because the behavior of issuers is going to be quite different. And personally, I kind of struggle to think, yes, we've had a lot of comment from regulators, supervisors saying that they're not really happy with the structure of AT1s, that they want to see it be more perpetual and more permanent forms of capital. But to be honest, I really doubt that a regulator would really care if one of the large banks refinances their AT1 50 or 100 basis points higher. I don't think that's a topic at all. And if you're invested in some that have weaker structures, thinking that they'll be called, I think that's kind of a misunderstanding of the nature of the instrument itself. I mean, then on extension risk, in the end, I think it's something that has always been the case. It's probably one of the most inefficient parts of the AT1 market, where when sentiment's strong and valuations are richer, everything trades to call, and differentiation between weaker and stronger structures, i.e. high versus low back end, tend to be quite low. And then now we're at a time where the kind of spread pickup that you get for to take lower backends is absolutely huge. And I'm not talking about going into the absolute worst structures. I'm just saying going from a super high backend to just a strong and solid and robust backend where you expect it to be called in a normal time. You just get paid, I think, way too much. So I think that's an area that's very inefficient. And in times like now, there's quite a lot of opportunities by, kind of hunting those sort of dislocations.
And Bruno, what's your perspective? I mean, the non-calls equal reputational risk from your perspective.
I mean, first of all, I think we have to put the record straight a little bit, though, Keith, because as far as I'm aware, only 3 AT1s have extended, and they actually extended for obvious reasons. One was Lloyd's, and I think it was late 2019, and I think the PRA may have had something to say to that, irrespective to what the bank's management wanted to do. I think then when you had the Santander extension, I believe at the time, Santander was going through a management change where there was some uncertainty as to who was going to be the next CEO or not. So it's very difficult for someone that is outgoing to sanction a call or a non-call of an instrument until that is decided. And then it wasn't unsurprising to see that instrument taken out subsequently. The Lloyd's was, I think, every 5 years, so they've missed the first one. Let's see if they extend it again. I think we're going to get the decision pretty soon. We've seen a tender on that security. So if they've tendered for that security, maybe that means that security is about to be taken out fully with a new one issued, so there's no stub. And I think the third one was the Deutsche Bank, which again, I think because of the flux Deutsche Bank was going in, new CEO coming in, I think they probably had other, wood to chop in between than deciding what or what not to do with an AT1. So if we consider there's been 250 AT1s issued, if we consider that only 2 have been expunged, equitized, which came from the same issuer, and if you only think 3 have been extended and 2 subsequently called, and probably the third one about to be called, I don't think this whole notion that AT1 always extends, I think it's the contrary. AT1 always gets called,
right.
Which is why the way I think of it is AT1s are actually mispriced tier 2s. Because if you think about it, the coupons have all been paid, the calls are all getting executed. A tier 2 will follow the same path of an AT1 if it's a gone concern. So you actually have half the duration paying you excess spread. So if you look at the entire capital stack, I think the market has been confused this year why the AT1 to tier 2 ratio has compressed. But this is why it's compressed. It's compressed because you get paid excess spread for what is de facto the same type of instrument. And that's the harsh reality, which way we want to look at it. Now, Roman is absolutely right when he says you got to be careful which AT1 you buy. Absolutely. If you're buying something with a 300 reset from a third tier player somewhere, in middle core Europe, you don't know where it is, that's not going to have the same impact of, let's say, a Barclays, who every 6 months has an AT1 up for call, has lots of tier 2 to do, has lots of Emerald to do. So I think what happens is we can't think of an AT1 call on its own. We have to think holistically about the capital stack. And holistically, it becomes, if you extend an AT1, how should I think about your tier 2 callable? Does that mean you're also going to extend that? Because if you then are going to bring a new tier 2 callable down the line, I will not price it to the call. I will price it to the maturity. And so what you find is that the savings you can get on extending an AT1 are de minimis compared to the additional cost that you will have on the rest of your entire capital stack, given the perception and the unsecurity that you put into your bigger capital structure. Right. So I think that's why CS did what it did. I think that's why Barclays did what it did. But let's not forget, SCB2, one of the premier Nordic European banks, also paid, I think, around 75 basis points to refinance. So it's not just a CS story or a Barclays story. Even SCB, which is not as frequent as the other two, has also decided to pay up to refinance. And I think at the heart of it all is the notion of portfolio. You can't be thinking of an AT1 on let me get the lowest possible spread per trade. No, I need to think of what is my blended reset rate for all my AT1 instruments. And if I have an average of 450, 500, and I have to do one at 650 because it's just the way the market is, so be it. What I can't risk is not paying 650 and then seeing the rest of my capital structure detonate because I've decided to save 5 million sterling on an annual basis when I'm making billions and billions of profit.
Yeah. Okay. Yeah, well put indeed. I'm conscious that we've been going for an hour, and I think looking at the audience numbers, I think we've reached that kind of pivot point. So I wanted to ask Marco perhaps to take us out with some final thoughts, any kind of summary thoughts from today's discussion. Anything that we haven't discussed that you're particularly focused or even concerned about? Do you sleep well at night? I mean, are there other things out there that that perhaps you've got there latent sort of nagging concerns? And it just
I have a 9-month-old baby, right? So I sleep at night, so and so. But no, matter of fact, I think perhaps the one aspect we haven't commented on or discussed, which is very close to my heart, I think it's underappreciated, is that inflation solves a lot of problems for banks. Just we've discussed the interest rates, we've discussed the profitability, but the reality is the banks have deleveraged. The clients of the banks have not deleveraged over the past 10 years. The governments have racked up more debt. The corporates have racked up more debt. Households are very indebted in many parts of Europe. Inflation will dilute a lot of the debt, most likely, unless policymakers completely lose it and lose control of real rates. I think the outlook is we're going to be living with negative rates for quite some time, and even more negative than we're used to. So I think this will help asset quality. Not asset quality ratios, not the headlines we see, but the actual quality of the borrowers that banks have to deal with every day. So I think that's a positive note, I think, to close off the meeting here.
Yeah. Okay, final word from you, Romain.
No, I mean, I think I think maybe somewhat controversially, I think one of the question was, around how banks would fare in a recession scenario, and I actually think that seeing a recession scenario would be actually a positive catalyst for the sector. Seeing banks resilient in a very weak, macro environment, I think would be a good catalyst for a re-rating of the sector. So yeah.
Okay. And Bruno, what would give us a takeout comment?
Yeah, I mean, look, the only thing I would say to what Roman just said, I'm not sure if it's the takeout comment you want, but I have another one as well.
Yeah.
Is that I would just be careful what you wish for, because how long is a piece of string? I think a mild recession, Roman, I completely agree with you. But if we have like a proper recession where we're talking of deflation and commercial real estate prices are down 20-30% because the working from home now has become entrenched and banks are the biggest owners of commercial real estate assets, I'm not entirely sure the sector will re-rate because there will be a lot of question marks. But I agree with you. If we get a through the cycle 3-4% contraction for the next 2-3 years, I think you're absolutely right. I think the sector will re-rate because once again, it'll prove that it has got enough earnings power. It's got a lot of juice in there that could actually retain earnings and build capital going forward. The thing that keeps me up at night, and by the way, I do have 2 kids as well. They're older than yours, but they still keep me up awake at night. I think it's just risk sentiment. I think what I think we need to be mindful of, and I alluded to this before, is the liquidity angle. A lot of people forget that before Lehman, 6 months before Lehman, Bear Stearns happened. And Bear happened in March. Lehman happened in September. The market only bottomed in March of 2009. So whenever you go into these unwinds and these removal liquidities, it's a very long process. There's a lot of head fakes. There's a lot of bear market rallies that take place. And the urge that you have is always to jump in because you think the coast is clear, I'm going to jump in. The coast is clear, I'm going to jump in. So I think the only thing to be mindful of is, I don't know whether, use a baseball analogy, we're like bottom of the 2nd or top of the 7th. I have no idea where we are. But I do think you still need to be liquid. I think you have to be mindful. Risk sentiment is something we hold very dearly here because ultimately, we're entrusted with clients' assets, and as a result of that, we've got to make sure that we're taking all the right decisions. And, I don't think it's easy out there. I hope it'll be easy in the second half, but I've got a feeling it will get choppier in the second half as well. So we're just being very, very mindful of that and just trying to stay as liquid as we can.
Sounds good. Well, I guess if it were easy, we'd all be doing it, right? So, which is why I'm sitting where I am and not doing what you're doing. Okay, well, let's close the session there. I think we covered a lot of ground in the last hour. We covered all the high points. And so I wanted to thank all of our speakers, Marco, Bruno, and Romain, for their insights and comments today. Thank you very much for those of you who are still viewing. Hope you found that useful. I didn't have any questions, so to me, my takeaway from that is that all points were covered adequately and more than adequately. So thanks for that. We are doing many more of these sessions now. So we're in the preparation phase, doing one perhaps more focused on asset quality across Europe. So look out for that. We'll be out with that hopefully shortly with our save the date. So we'll leave it there. Wish you all a very, very successful rest of the afternoon, and we'll see you again next time. Okay, and it's bye from us.
Thanks very much.
Thank you. Bye.